Welcome back to Data and Context. I'm Allie Barefoot with Cotality. This episode is a part of a new series on this channel, and we're going to be diving deeper into the major natural disasters and their consequences, one by one, exploring factors creating risk and opportunity in the housing market today. By the end of the 2025 hurricane season, there were 0 U.S. hurricane landfalls. It was truly a reprieve. And this near-miss season delivered a stunning paradox that is fundamentally changing the way that we understand risk. For millions of residents along the coast or near the coast, between the months of June and November, there's one thing on their mind. It's a constant threat of a complete catastrophe. These acute perils, they're sudden, disastrous, and they can leave your insurance premiums soaring through the roof. That's why today we're going to be breaking down the data with Cotality's Director of Research and Content, John Schneyer, and we're going to be exploring what exactly this near-miss season taught us. Let's go on ahead and jump into today's questions with John. John, thank you so much for joining us again on Data and Context.
Hi, Allie. Great to be back.
So I want to talk to you a little bit here about the acute peril hurricanes, and this is really timely as the 2025 hurricane season just came to a close, and it actually ended with 0 U.S. landfalls. Yet, 3 Category 5 storms formed. Since a hurricane is an acute peril, how rare was this American dodge? And what does this near-miss season tell us about the fundamental difficulty in predicting these intense hurricanes wherever they may land?
Well, I think what it tells us about predicting hurricanes or forecasting hurricanes at the beginning of the season is that it boils down to luck sometimes. The National Hurricane Center, a number of different research outlooks, all forecasted an above average season in terms of activity. Now, you can define above average in terms of the number of storms or how many of them become major hurricanes or how much total energy there was in the storms, but pretty consistently that it was going to be above average. And it turns out, ended up being an above average season. They actually weren't wrong. What was interesting is that, this is the first year after 9 consecutive years where there's been a Gulf Coast hurricane that made landfall. It's the first year we didn't have one. And like you said, we had 3 major hurricanes, fairly active season, technically about the 67th percentile in terms of total energy from those storms, right? So a more active season than 2/3 of the other hurricane seasons on record. It just came down to roll the dice. Didn't hit the U.S. this year, which, in the grand scheme of things, is great news.
And Cotality's 2025 hurricane risk report came out just slightly before the hurricane season started, and it identified over $11.7 trillion of reconstruction cost value in the U.S., spanning from Texas to Maine. But risk is a very individual thing. That's why we look at street-level data and individual homes here at Cotality. How should communities and insurers rethink high-risk zones when parcel-level data shows that small differences in elevation or distance from coast can change a property's risk score completely?
Yeah, it's a really good point because I actually happen to live in a home where this is the case. So I live in a coastal community in New England, and my home is less than a mile from the coast, from the ocean. But we are 75 feet above sea level, happen to be at the top of a very large hill. So if you look at our flood risk, 0, despite the fact that I would be in a high risk zone just from the standpoint of from a flood standpoint. Now, that doesn't account for wind, which is a big consideration when you're so close to the coastline, but it does matter when you think about the individual characteristics that comprise the buildings built along the coast. If we go back to any of the big hurricanes that have made landfall in, say, Florida over the last few years, I think about Hurricane Ian a lot. And I saw a lot of pictures of properties that were completely destroyed, but a lot of pictures of beachfront homes that looked like they were untouched. And they looked like they were untouched because they were built to a very modern, very stringent building code. Now, luckily in Florida, right, they have really good building code design rules in place for along the coastline especially. And when homes are built to those codes, when the roofs are tied down strong enough, if they have hurricane shutters, they use if they make sure that the actual material of the roof, the shingles, are attached appropriately, you can survive a Cat 4, Cat 5 hurricane. It looks like there's very low damage. And I'll say from a flood standpoint, We talk about first floor height here at Cotality a lot. It's really important to consider the first floor height because a property could be in the flood zone along the coast, but if it's elevated a foot, 2 feet above the base flood elevation, that 100-year flood elevation, well, the likelihood of there being flood damage is reduced extremely, right? So just because a property's location is a good firsthand approximation of the risk, but the actual characteristics that make up that building can play a huge part in just how much risk is actually there.
It's interesting. I guess you're the perfect person to talk to considering where you live on the coast. It's wind isn't the biggest factor where it may possibly be, like you said, in a Florida, but we do know that a hurricane is obviously such a disastrous acute peril because it's a mix of so many things. Wind, inland flooding, and it just comes from coastal flooding or the rainfall alone. So, since flood insurance is often separate from wind coverage, how does Totality's catastrophe risk model and platform untangle and quantify the financial loss from the storm surge alone?
It's a good question. And like you said, so flood typically not covered under standard home insurance policy. For the most part, flood is covered by the National Flood Insurance Program provided by FEMA and the federal government. So insurers really care about potential wind damage at the property, especially when they're modeling risk, hurricane risk to their portfolio. And catastrophe modeling platform like Cotality's Navigate or RQE have the ability to just account for, say, the wind damage versus storm surge flooding. It's as simple as checking a box when you're setting up the model run. You can say, no storm surge, and it won't include those losses. You can look at just the wind. What is really important when you're looking at these model losses, you consider something called leakage. It's kind of an industry term because if you think about when a hurricane hits, now, like I said, insurance policy only going to cover wind damage, but you don't always know if that damage was wind or water. And sometimes there's some water damage that gets called wind damage and your insurer covers it. So sometimes what we'll do is we'll turn off storm surge, but we'll include a 5% leakage. So we'll take about 5% of those storm surge losses and tie it in just to account for that. Yeah, maybe water damage is actually what hit those properties. So the models are actually really good at separating the different sub perils, I'll call them wind versus water, whether that be coastal flooding or inland flooding. Water damage is water damage. So in the long run, it ends up being, it's wind versus water is really what the insurers care about.
Water damage is nobody's friend.
Nope, not at all.
Like you said, there could be numerous different categories of what this hurricane damage actually is in terms of insurance. And you have to also think about the costs and materials of labor too to rebuild. We know that Cotality tracks this. And it's calculated that there are 33.1 million residential properties in hurricane prone areas, which is astronomical to even think about. When you think of those areas with a combined reconstruction cost value of the $11.7 trillion, how does constantly integrating data on soaring material costs and labor shortages, how does it allow insurers and homeowners to understand their true financial exposure, whether it's before a hurricane may come or after a hurricane has hit?
It's probably the most important consideration, to be honest, relative to say how storms are changing in terms of frequency and severity, because what's really driving changes in insurance premium costs, I'm not saying this the case all the time, but a lot of these macroeconomic factors are really what are, you know, the reason why premiums might be increasing in one area versus another. So having an updated reconstruction cost value estimate is paramount to pricing a policy. If you think about it, if you say don't know the full reconstruction cost of that home, or you underestimate it, maybe didn't have the square footage down correct, it was a different type of roof, different type of building material, what have you. But you assume if this home was damaged 100%, we would have to pay out $1 million. But in reality, it's about $1.5 million to rebuild. Well, there you go. That's $500,000 that you didn't account for in setting premiums. And that's just the one property. Now you kind of snowball that all the way up through your entire portfolio. Well, when you start thinking, all right, well, maybe the reserves we have on hand to cover claims isn't adequate. So at Cotality, we're really proud of how we continuously update our modeling and data sources that comprise the reconstruction cost values that we used for those stats that you read in the hurricane risk report, the 33 million residential properties across the United States in a high risk area when it comes to hurricane damage, with a combined reconstruction cost value of nearly $12 trillion. Now, I'll caveat by saying, right, there's no single hurricane or even a single hurricane season where all 33 million homes are going to get hit. That would be insane. You would have to have a hurricane, category 5 hurricane, trace the coastline all the way from Texas to Maine. But it speaks to just how much value there is tied up in our financial system in this country that is at risk to hurricane winds or flooding.
Sort of like Tornado Alley. When I think of tornadoes, I think of Oklahoma and the Midwest. When I think of hurricanes, I tend to lean more towards Florida and near the Gulf Coast. And I want to kind of shift here to Florida because I think they're a really good example that this was the first time in 4 years where a U.S. hurricane landfall did not hit Florida, which is fantastic news, especially because of the monstrous hurricane that did hit them in the last couple of years. I wanted to ask you, did this 2025 reprieve allow local insurers to significantly recover and stabilize from those previous hurricanes because they did not have to reconstruct this past season? And how is that systemic issue really impacting these insurers? Is it still pushing premiums out of reach for middle class homeowners, or did they finally get to take a breather this year and kind of figure out how to move forward?
So my answer is going to be sort of yes and no, and it's incredibly complicated. Now, that
Right.
being said, a year without hurricane cat loss in Florida is great for the regional insurers that are in the state. And even national carriers that have exposure to Florida are happy that there isn't another 35, 40, $50 billion loss in the books because they're probably still dealing with the aftermath of the LA fires, severe convective storm
Right.
season that we've, or severe convective storm year that we've had. Now, just because we had 1 year without a landfalling hurricane in Florida, that doesn't mean things are great. It doesn't also mean things are terrible. And I would say actually in Florida, insurance market, which has had a lot of attention over the last half decade, things are really starting to stabilize and for the better. Now, I'm not going to say, and I think it's valid to say, it's not because of hurricane activity. A lot of those macroeconomic trends, or actually legislative trends that have, or legislative actions that have been taken in Florida, have a lot to do with that. So, minimizing costs that insurers pick up because of litigation, claims that go to court. So, they minimize that. Insurers don't have to bake those costs into their premiums as much as they used to, if they still do. And the other thing is there's actually increased competition in the state. So more carriers are entering the Florida market. Great. More competition lowers premium. That also reduces the number of policies that are under the state-backed insurer of last resort. It's called Citizens. Obviously, in you don't want the state-backed insurer of last resort to be the one that takes the biggest hit, because then everyone in the state, through taxes or what an assessment, are going to have to make up the difference. So, more carriers are entering the state, fewer cat losses. Even going back to last year, Milton wasn't as bad as maybe originally thought 2 days before landfall. You go back, Ian obviously was a pretty bad one, but over the last 5 years, not as many big losses that are really killing the state. And it's actually starting to look pretty good. I was just reading an article right before we jumped on that Citizens is even thinking about rate reductions for policyholders in the state, which is great news. That means that right they're able to have reserves on hand, capital on hand to pay claims, and reinsurance costs are a little bit cheaper. So they don't. It's a little bit easier for insurance companies to insure themselves against losses. Now, that's all great stuff, working towards stabilization of premiums in Florida. But Florida is still it is still more likely that there to be a hurricane in Florida than there is anywhere else in the continental U.S. It's the nature of where Florida is and where hurricanes form and how they move across the Atlantic or in the Gulf. So relative to the rest of the country, insurance premiums are still probably going to be higher in Florida relative to other places. It's the nature of the beast, unfortunately. But what is good to see is that there is some stabilization in the market in Florida.
Oh, that's Definitely a good positive note to end on there because, like you said, it's just kind of inevitable. And most residents, obviously, when they do move to Florida, that is number one on their forefront is that hurricane season because it takes up majority of the year. And you mentioned severe convective storms, so I kind of want to look ahead here in 2026 as the Atlantic starts to kind of quiet down. The focus shifts to the central US. Tornadoes, hail, and straight line winds is now the single largest driver of insured losses in the US. So, what makes SCS, severe convective storms, a different kind of acute peril compared to a hurricane?
I think it's because this concept of a season is a bit of a misnomer with SCS. Now, with hurricanes, there really is a season. Oceans cool off after November, and they're cool before May, or there's steering patterns that keep hurricanes from even making it close. So there really is a season. But what we're seeing these days is that there really is no quote unquote season with severe convective storm. It can happen all year. So there's just more time of the year when you can have damaging hail, winds, or tornadoes. And that creates this sort of death by a million paper cuts kind of concept where you're not going to have the one big hurricane that causes $50 billion. But over the course of an entire year, and right, you could have hail falling in a given week, could be 6 out of 7 days. If you think about how much of the country can be impacted by hail, if you add all those little single days, add up over the entire year, over the entire country, or most of the country that could be impacted by severe convective storm, wind, hail, and tornadoes, right? That ends up causing $50 billion of insured loss, which that ballpark is what we've seen each year over the last couple of years. So it's not limited to one area. It's not limited to one time or any one particular time of year. It's sort of this constant, ongoing hit to your books, and that's why it's become this sort of high frequency, low severity peril has become uh, right. It's the center forefront when it comes to cat risk management. Is we're now really concerned with the severe convective storm and the losses it's causing in the long term. Um, and it ties back to those larger macroeconomic trends I spoke of, right? Things cost more to rebuild, roofs, siding. Maybe there's underestimation in the reconstruction cost value of all the properties that are being written for new insurance policies. And if they're constantly being hit, it's going to add up in terms of insured losses. And that's what's really causing a lot of pain to these big national carriers that write across huge parts of the United States.
I kind of have a final question. It's sort of broad to end on here, if you don't mind. We've talked about a couple of cute perils here in this podcast. And if you had to name a challenge the property insurance ecosystem must tackle in the next 12 months, what would you say that is? Because I know at Cotality, are great big events that talk about these type situations and big events like Interconnect, which is actually coming up here in January. How do they help turn that necessity into real world solutions?
I'm glad you brought up Interconnect this year because the tagline for our conference this year, for our industry conference, is intelligence beyond bounds. We are a data model and insights providing company because what we are focused on is understanding all those individual little characteristics of the property that comprise the home or the commercial building and what that means for you know potential losses to that property. So really having a really deep understanding at a really granular level, and that's what we try to bring to the market. That's one of the challenges that a lot of not just insurers, lenders, real estate, government, where they struggle with is data granularity and data quality. And the other thing that another challenge the industry faces and something that we try to address with these industry conferences is just to bring these different groups together. And we focus on insurance, but we like to think about it for the entire lifespan of the policy, right? From underwriting, right? From getting a better understanding of what is there on that parcel, what kind of roof it is, how many floors, when was it built, what's the reconstruction cost value, all the way through the cat risk management, how that impacts your portfolio and your reinsurance making decisions, your capital management strategies, to the claims process, how we're going to address the claims, and the restoration, how we're going to rebuild that property back up to 100%. So whatever family was impacted can return home as much as possible. So bringing all these groups together having those conversations are going to help address some of those big challenges that really arise because some of our industry can be so segmented.
Yeah, I'm definitely looking forward to Interconnect, seeing what Cotality's leaders do come together and bring to the table here. But that is all I have for you today, John. Thank you so much for joining me again on Data and Context, talking about the 2025 hurricane season. And who knows, maybe we'll have this conversation again next year and see how the 2026 hurricane season played out as well.
Absolutely. Thanks for having me, Allie.
Thank you again to Cotality's Director of Research and Content, John Schneyer, and thank you so much for joining us here on Data and Context. If you guys haven't already, feel free to leave a review and hit that subscribe button. And as always, if you want to learn more information, head over to cotality.com.